Hi, this is Jon Guest, and I'm just going to go through a couple of answers to the questions in the latest edition of the Economic Review, the September 2016 edition. And in particular, these are just two short videos I'm going to do based on the questions on John Sloman's article on climate change. So first of all, if we just look at question 2, obviously in the question, just a quick resume. If we look at figure 1 in the article, it assumes that the marginal external cost of producing the steel is constant, so the marginal external cost is drawn as a horizontal line. Now what we want to do is just change that and just imagine that if at low levels of output, production of steel produces no negative externalities, then once a certain output is reached Q star, additional units of steel will produce externalities or external costs. And unlike the diagram in the article, we're going to assume that those external costs increase. So each unit of steel after Q star produces a higher external cost than the previous unit. So how would we redraw figure 1 to illustrate this new sort of pattern of externalities? So hopefully I've had a go at just recreating the figure straight out of the article, figure 1, with the upward sloping supply curve and the downward sloping demand curve. Obviously we're assuming there's just externalities in production, there's no externalities in consumption, so the private benefit and the social benefit are equal. So if we remember the question, we're assuming that from an initial output, just from 0 to Q star, there are no externalities. So the marginal external cost is going just to follow the horizontal axis. Then, as output expands beyond Q star, we actually now get external costs. And remember, as we said before, those external costs are increasing. So therefore, each unit of output after Q star, the externality is greater than the previous unit. So now we're going to get an upward sloping marginal external cost line rather than the horizontal one in the figure. So that's this marginal external cost of production. It's got a kink in it. It's a horizontal line up to Q star because the marginal external cost is 0. And then after Q star, it has a positive slope. It starts rising because the marginal external costs are rising. So if we now want to create our new marginal social cost line, external costs plus our private costs, well, from point F to point G, the marginal social cost is just going to sit on top of the marginal private cost. So I think I've just put that as a purple line. So from point F to point G, the marginal social cost is just going to sit on top of the marginal private cost. Then after point G, now we've got a positive marginal external cost of production. We just need to add that on top. So the distance here should be the same as the distance here. And this is our new marginal social cost line. So again, it's got the kink. It's just the same as the marginal private cost up to point G, and then it pivots upwards after this point here. So we can see in the perfectly competitive market, just the same as in the diagram, the social costs of production at the perfectly competitive outcome are greater than the private costs. Point C, where the marginal social cost, our new marginal social cost, intersects our marginal social benefit, is the efficient point for society, which I've labelled as QE. And we can see that the area BCA would still be the area of deadweight welfare loss, as it was in figure 1 in the article. And actually, as we had before, in a perfectly competitive market with a negative externality in production, the market overproduces. It produces too much because QPC, the output in perfect competition, is greater than the efficient output. Hopefully you found that useful, and there'll be a second video that deals with question 3 from this article.